Hello and welcome to this week's Gig Harbor Real Estate Market Update. We're going to be covering the latest of Gig Harbor's data, and it is something to talk about, and that's why we're talking about it today on this great rainy day where pants are optional. March has come and gone, and here we are in April, leaving us with cold weather and some fresh hot data for us to look at from the Northwest MLS. What we're gonna get to that here in a second. I'm getting ahead of myself here, but I'd like to quickly go over what I predicted in last month's email about what I predicted for March, and that was basically I was seeing a sluggish seller side, as well as maybe an uptick in buyer activity caused by what the Fed was doing and their plan for interest rates. And let's quickly look at what happened in March with interest rates. Here we see, let's see, get my cursor. Here we see March 3rd, we see interest rates ticking up and then, ticking down here to below 7%, which was great for buyers who were looking to buy in March. And I think that kind of spurred them on as I predicted. And now we see rates tick up, and I think they will continue to do so here, probably above what we saw here. We'll probably peak out maybe 7.15, and then it'll probably taper down for the rest of the year. And that's what the Fed stated. They want to raise rates one last time this year and then kind of pause and wait to see what a 5% Fed funds rate does to the banking sector. And hopefully they won't cause any more banks to collapse. Fingers crossed. But basically, I think this rising interest rate here going into maybe April and maybe into May will probably depress the buyers a little bit here. But I think, just the nature of the spring market coupled with the low inventory will probably cause, there's slightly to be some competition still, despite what's happening to the majority of buyers who I think are opting to rent. But more on that later. Let's get right into the data here, starting with the median sales price. We're gonna hop on to the InfoSparks here real quick. We're gonna type in Gig Harbor City. We're gonna do residential, we're gonna previously owned, and I'll leave the rest of the stuff as it is. We can look at, let's do just 3 years. Rolling 3-month data. And of course we're doing sales price. Here we go. February we saw 700,000, and bada bing bada boom, here in March we see prices flatline like I predicted they would here at the beginning of the year. So we've seen prices flatline and most likely bottom here. So I don't, depending on April's inventory levels, I don't see prices fluctuate too much in either direction. I think we probably will have a slightly tick up here in the median sales price, but nothing too drastic that'll cause people to panic. But the news reports, as we said in a couple months ago, that they might say, hey, they'll see this year over year, probably in June, they'll say, oh my God, prices are at like 700 and something, prices are down 30% or whatever, that number will be. And that might, cause a little bit of panic as people don't quite understand the data. But basically what I'm trying to say here is, let me pull up my email because it has the data here. Month over month, we're flat, 0%. Year over year, we're still up. So you can see that we're $25,000 up. And then I said here's a summary that April, if inventory is low, we probably will see prices move either way just because of low inventory distorts prices. That's basically it for median sales price. Let's move on to new listings. So for new listings, we're going to click here. I think let's do more of a bigger picture here. Let's do at least 5 years. Should we do 10 years? Not that matters much. Let's do just 5 years so you see the picture. But basically here we are in March, and look at that tick up. Wow, we got 50, to be exact, 51 extra new listings here. That was, quite a bump here from 93, 101 to 152. However, while it does look like we're back into these troughs here, those are January and February troughs. March is supposed to be up here at over 200, so we can go back and look, 211, 220, 207. So you can see that our March is actually the lowest March since data goes back. So you can see that this low here does not occur anywhere since 2006. So that's kind of troubling for buyers going forward, as the inventory here, new listings, means that the inventory will be depressed. So while we did have a good here tick up, let me show you the percentages. I pull up here. So yeah, you look at the month over month, you're like, wow, 50% up. But then you look up year over year and they're down 52%. So this means that this is, again, I'm going to reiterate, because it is an important point here, that March has the fewest amount of listings of any March since data has been collected. So that's going to be important moving forward and looking towards what's going to happen in April. But now let's move on to days on market, because that also paints an interesting picture. Now, days on market is pretty simple. We just go days on market here, and we see that it's kind of a funny graph here. It doesn't make much sense. Okay, let's go back 10 years. Basically, we have these spikes as we get into the winter months, and then when the spring, kicks off, people are looking at houses to buy them in earnest, and they kind of fly off the shelves here. Let's see, we had this was the weird COVID distortion of housing. We had, 5 days on market or less. And then we jumped up all the way to 50 in February. And because of the low inventory increased with the buyer activity, we have actually decreased substantially here to 35 days on market. So just shy over a month that the average house or the median house is on the market. So as you can see here, let me pull up my email again, because that gives you a better picture here. Since COVID, we're up 600%. It's an extra 30 days on market. However, down from our peak here in February, down by 31%, so 16 days. But yeah, so I would like to see this continue to go down. I expect this to continue to go down as we enter April here. And then we're going to be looking at inventory here, because that'll, that kind of affects everything really, including days on market. So let's look at inventory here. So let's go month's supply of pending, and let's do 3 years first. Let's do 5 years. Here we have 1.22. So both for February and March, we've had inventory flatline. And now it looks like inventory is lower here, but again, yes, it's true, but this was during the COVID frenzy, and I don't like to use that as historical data because it's not reliable. So I like to look at what happened prior to that, and so we have here a low of 1.3, a low of 1.6, and 1.4. So despite it being March, here we have, a 1.4, a 1.6. So we're still at historic lows if we avoid taking this into consideration, the COVID years. So that low amount of inventory, so despite the fact that we've had new listings tick up, the fact that we still have 1.2 months of inventory means that the buyers are there snatching up the new inventory. So it's kind of a tough deal for buyers looking to to find that perfect house. And we have seen multiple offers still on the right house that's priced right, good location. We've seen something similar to offers that were kind of the stereotypical offer back in the COVID years, where they waive inspection and basically say, here, just give us the house, we don't care, we don't look at the insides. So that's what's happened for choice houses. However, not every house is priced the same way or has the same appeal, so that affects some houses. But for the most part, the buyers are absorbing most of the inventory that's on the market right now, and we'll probably see that going forward. I can't imagine that April is going to have too many more listings, and so this might just tick up a little bit depending on the buyer activity with the rates moving forward. So if there's more inventory but rates go up, we might see this tick up as more inventory comes online, but don't expect much. Now, as inventory is down and buyer activity is up, we can see that by looking at shows per listing here, and we can see that, oh, look at that, shows per listings are up from 6.2 in February to 7.6 here in March. And that's really due to the fact that there's just so little inventory. So, buyers say, okay, well, let's look at that house anyway, because there's not a lot to choose from, and it's just supply and demand really. So a lot more demand is going to those houses, and this doesn't consider any open houses where people do move through. So this is just showings through an agent. So if you included open houses, which is kind of hard to track, but and this would be a lot higher. But let's see here, I have some data on it. So basically, month over month, we did have a 22% increase in foot traffic, essentially. However, year over year, we're down about 50%. So that's here. Let me show you. March up here. So we're, we see that dip, and those are the COVID years. If we go over, it only goes back to 2019, but here we see, 2. So we do have a substantial buyer demand still interested in Gig Harbor, much more than we had back here. But I don't know if this data is flawed or not. So it'd be interesting going forward. But anyway, that's just what's happened here with foot traffic. And with that said, I think I can pretty much wrap up here and go into one more news report and my conclusion here. So let's start with the conclusion, and then I'll draw on this little Yahoo report. All right, just to put a little bow on this email, just to wrap it up and give a conclusion and then my thoughts. Basically, March listings show that there is still a substantial buyer demand despite the high interest rates. So the buyer demand is absorbing that additional inventory. However, because of the fact it's historic low inventory here in March, there's just not a lot that's buyers can choose from. So they are, if the right house comes on the market, there is still a high demand for it. So we do see multiple offers on those. It also looks like we've bottomed out here at 700,000. That might go up and down by $5,000 to $10,000 at the probably here coming in April. But I don't see too many wild swings here, especially as the Fed increases their interest rates. So you kind of have the interest rates depressing housing prices, but also the fact it is spring pushing prices up. So you kind of have a competing influences here on the housing prices. So we're going to see which one wins here, and we'll probably see. I don't know. It's kind of a toss-up, really. Not really important. Basically, we kind of flatlined, and that's the important part as we go forward, and the news starts generating some of this fear-mongering. Anyway, next point is that the Federal Reserve will pause rate hikes, hopefully for the rest of the year, after one more 25-point basis increase. We're going to see what happens to the banking sector. There is always that black swan event, which can throw everything I'm talking about just to the wind. Hopefully that 5% Fed funds rate won't cause any more banking collapses and investors doing weird stuff. But there's always, some contagion event that can happen. But let's just assume that 5% and everything is just copacetic. We'll probably just see prices flatline, as I've said multiple times already. And the last conclusion point that I wanted to talk about was the fact that high interest rates actually keep people trapped in their homes. And what do I mean by that? Let's pull up this article here. I know this is from last year, but I don't think it's changed too much. Basically, it says half of U.S. homeowners with mortgages have a mortgage rate under 4%, substantially below today's level of 6 or 7%. So that's... And then here it says a third of all homeowners, including those without mortgages, have a mortgage rate under 4%. So, okay, one more point before I get into what the point I was trying to make. We're prisoners. 3% mortgage rates are a blessing and a curse. Basically, people can't afford to sell their homes because the interest rate and their payment will be too high for the slight amount of improvement they're going to get. So people are essentially stuck in their home and they're unable to sell. And what does that mean? It basically means that all this but I would say 50% of the people that are looking to sell with a mortgage are going to be looking at the fact their new interest rates are going to be so high. This causes a lot of people to take their homes off the table, meaning that all this inventory, potential inventory, is just gone until interest rates come down. And that is having an interesting effect, and that's mainly on the rental market. A lot of people are opting just to wait it out, mortgage rates are too high, 7%, we're going to wait for them to come down, we're going to rent in the meantime. So next year, by the time, this is somebody else talking, not me. By the time next year, we're going to be out of our lease, and then we're going to be able to afford a home when, interest rates go down to 5 or 6%. What is happening? Well, what's happening is it's driving the rental prices up because so many people are opting for that, but it's also increasing the pent-up demand. So when mortgage rates eventually do come down again, assuming there's no black swan event, it's going to have an interesting impact on whatever market is going to be upon us in a year from now, especially as the leases run up and people are looking to, instead of pay rent checks, they're going to be looking to pay for mortgage. So that's going to be an interesting tidbit going forward. But basically what I'm trying to say is interest rates are keeping people from selling and not just from buying too. So there's an interesting dynamic that's going on right now. So basically that's it. That's the latest news you can use. And thank you, and hopefully you enjoyed some time with your pants off. Oh, hold on, that didn't come out right. I'll leave it in. Anyway, I bid you a good day. Thanks for watching, and I'll see you next week.